Well, for more analysis, we're joined now by Georg Grodzki, the Global Head of Credit Research at Legal & General Investment Management. Thank you so much for speaking to us. So, really, a key concern amongst finance ministers and central bank governors gathering for the G20 meeting will be the impact of Europe's sovereign debt crisis on global economic growth and indeed recovery.
Indeed, it is very topical, even though we have to put things in perspective. It's not just Europe which has a sovereign debt crisis looming or already breaking out. It is also the Anglo-Saxon economies which face, at some point, will face the task of tackling deficits. Right now, the attention, of course, is centered on certain Mediterranean countries, which brings some relief because of flight to quality benefits for other government bonds, such as German, such as UK, such as treasuries, of course. But the question is, how long will it take markets to realize that the US is not in a much better position than Europe as a whole?
Well, we've seen a great deal of volatility over the past few weeks in European and indeed US markets. How do you assess, how would you describe sentiment right now?
Very fragile indeed still. We had a few days of relative calm with equity markets maybe showing less volatility than before, but we're still on an edge. We have to face a big headline risk over the next few weeks as a number of European sovereigns will have to come to the market with sizable funding needs. It will remain to be seen how willing the markets will be to take up that massive amount of issuance. So far, the progress in debt reduction in Europe actually wasn't too bad in the first few months of the year. That's something to take heart from, but will it suffice to bring these bonds to the market and allow a smooth placement? I don't know. We expect a very rocky ride for government bonds over the next few weeks, and probably that will affect equity markets and credit spreads as well. And of course, there's still the worry about the exposure of European banks to a possible escalation of the European debt crisis.
How serious is this exposure? Just how rocky is it going to be?
It depends, of course. Banks are already on life support from the ECB. They can draw on ample liquidity facilities, so therefore they can taper over if you want. So the problem, but the market will still remain suspicious. And what we're facing here at the moment is that leading European banks, including the well-rated, solid ones, are unable to raise a large amount of wholesale funds at sustainable credit spreads, i.e. funding costs. And therefore, it is still unclear how they will refinance what is coming due this year, and therefore the banking system's fragility in terms of its ability to fund itself in the wholesale market is one of the Achilles heels at the moment, and of course that is related to the bank's exposures to sovereign creditors, and it's difficult to gauge how big that is and whether they at some point in the future, and that could be 2 or 3 years away, they have to face some markdowns on their Greek and possibly other
So we could see
holdings.
further write-downs.
We could see further write-downs, and I haven't even mentioned commercial real estate as another potential source for bad debt provisioning, so therefore that's looming somewhere in the background. But of course the significant holdings of European banks in sovereign debt are exposed to mark-to-market volatility, at least, and of course further down the road we'll have to see whether one of these governments may have to ask for some debt forgiveness in order to get back on an even track.
Thank you so much for some very interesting comments and insight from you, Georg Grodzki. Thank you, appreciate it.